JPMorgan out with its annual Global M&A Outlook. This year, it's titled From Turbulence to Transformation. Joining us right now is JPMorgan's Global Head of Advisory and Mergers and Acquisitions, Anu Aiyengar. JPMorgan, we're very glad to have you here.
Happy to be here.
All right, so the lead story today in the Wall Street Journal is about how deals power a record year for the big banks.
Yeah.
It was the investment activity that really picked up, the M&A activity. So a lot of things that happened, and it did turn out for very big numbers. You would characterize the year a little differently, at least where we were 6 months ago.
Yeah, because I was here about 6 months ago, and it was a very turbulent year. And I think much has been said, including in this forum, about year of the mega deals. We had 71 deals north of 10 billion, more than 5 trillion in volume. I thought what we may do is double click on why it is that scale matters. Why is it that companies are doing large deals, right? Because just scale for scale's sake kind of doesn't make that much sense. So in a world, from a company's perspective, in a world you have tremendous amount of uncertainty and risk, geopolitical risk, macro risk. I need to have more control over my supply chain. I need to be tech enabled. I got to think about AI. I got to think about disruption. When there's that level of risk, more levers that you have to pull, the more amount of money that you have to reinvest in your business, the more scale you have in your business, you're able to navigate that environment a little bit better. And at the same time, on the investor side, and you all talk about it, right? Companies hitting $1 trillion of market cap. The size of a company, of what it takes to be in the S&P 500, 600, has doubled, tripled in the last 5 years.
Really?
So you see that, and the number of...
We have $4 trillion plus market cap companies. I remember talking about who's going to be the first to break $1 trillion.
Exactly. The number of public companies has also declined. Yeah. So if you're an investor, and you're an active investor, trying to beat these indices which are hitting all-time records, it's kind of hard to do that by investing in a $1, $2, $3 billion company.
That's true. I think I just heard Jamie Dimon say that in an interview, too, where we've gone from, I think, 8,000 publicly traded companies to 4,000.
That's right. And at the same time...
You? Like, where are the companies to buy at this point?
Well, at the same time, the private companies, right?
Getting bigger and
when
bigger.
you look at the number of companies which are either in private equity hands or new company formation, founder-owned companies, you have more than 30,000 companies in that ecosystem. And that ecosystem, if you go back to the same 8,000 to 4,000 time period, was like 5,000 or so. So that has grown. And this private capital ecosystem, whether that's private credit, private equity, private capital solutions, that part of it has become a much bigger part of the market. So as a company gets very large, and we are talking about some very large IPOs coming to market this year, and these large mega deals, there's a place for that. And then for the smaller companies, the private capital market has been a much better solution.
Do you see, a lot of companies that say they're going public? Used to be that sometimes you hear about a company that's planning to go public and all of a sudden there'd be a takeover of that company because it was like, okay, now it's for sale. With some of these big companies, though, are there other companies that even can do such a thing? And is this regulatory environment, even though I think President Trump has talked about trying to, open the spigots for certain types of sort of headline-grabbing deals, he could be more in the sort of Bernie Sanders camp of things in certain cases.
Yes, I think the regulatory environment has actually been, it's not that every deal gets approved, right? But when you hear the head of the FTC, head of the DOJ talk about what it is that they want to see, they talk about wanting to be constructive. They are responding both to structural remedies, behavioral remedies, want to understand the deal. Every deal does not have smooth sailing. So it's not, come on, this is bonanza, everyone announced deals, which is also a healthy part of the market, right?
I just talked about bonanza. That's funny that you said. Recently we had an interview about, are we doing something wrong to keep in terms of regulations, or not making it? Is it not conducive to public ownership? Because we need it, and there are, for investors and everyone else, there is a scarcity of public equity. Is it something we're doing wrong? Is a regulation still too stringent? What is causing people?
So I think for a company to be public, one is, you do have to deliver on a quarterly time frame, which is a bit harder. So when you have to have transformations in companies, which takes a longer time period, right? We talk about the classic case of why a company goes private or why a company stays private. And historically, some of the reasons why you could not do that is because you didn't have enough money in the private markets. So you said, oh, I want to grow, I need to use my currency, and so I need to be public in order to do that. Whereas today, the private capital sources are large enough, right? We just talked about the secondary market growing 60% year over year.
Yeah.
So you said, earlier, exactly as you said, there would be companies which think, I can go public or I can sell.
I mean,
Whereas today...
it seems like in terms of inequality and everything else that we talk about, probably not good that...
If you're an average investor, you can't get access.
Or you've got to open up the private markets, which also you get blowback from that, that they're not...
Having a robust public market is a good thing, and having more companies be public is a good thing. At the same time, having plenty of private capital that's available, and all private capital is not just these large private equity firms, right? Because you have several middle market private equity firms, several founder-owned companies who are raising money from friends and family and are able to do that in today's environment versus 20 years ago, where you wouldn't think about doing that. So several new companies getting formed, several founder-owned businesses, and that ecosystem being very strong.
Okay, what would slow down the deal activity this year? We're expecting some really big numbers, probably a record year. What would slow that down, and what's the likelihood of any of those things happening?
Look, I think we still have a lot of risk and a lot of changing policy.
Yeah.
So that impacts, I think, the psyche of people, and deals beget deals as well. So currently we're in a little bit of an environment where you see one deal happening in a sector, you see more deals happening. The financing environment has been very favorable. The investor community has been favorable. And the synergies that people have said that they're going to get out of those deals, there is a lot of thought and work that goes into it, and boards have been supportive. So the ingredients that you need all of this to be pulling in the same direction. Anyone in this ecosystem has a shock, then you have to deal with that challenge.
Right. And
likewise, I think you may see a lot more of deals in this in-between spectrum. Because you saw, I think, over $1 trillion of minority deals last year, right? That's 20% of the overall M&A deal volume. So deals which are structured, which are not straight, just I sold 100% of the company, I merged this much of the company. Structured deals, staggered deals where it's not 100% sale at one point of time.
It's over, right.
You do it over time, partnership deals.
Right.
All of those types of flavors that we'll see as well, more creativity and innovation in deal doing also, not only in the businesses that companies run.